All right, grab your notebooks because in this explainer, we're literally sketching out the entire financial ecosystem. Have you ever actually stopped to wonder how money moves, how it grows, or how it gets regulated in our economy? Well, today we're going to draw out the exact mechanics of the banking system right here on the page. Let's jump right in.
So, to really grasp how financial systems operate, we first need to draw a hard line between the big regulatory authority and the commercial units that work beneath it. Let's place them side by side in our sketch here. On the left, you've got the central bank. Think of them as the overarching boss. They aren't in this to make a profit. Their entire goal is just pure economic stability. Now, over on the right, we have the commercial banks. These are the commercial units working under that central umbrella, and they are driven by profit. Their whole deal is to mobilize savings and issue loans to the public.
Section 1. The ground level. Commercial banks.
Now, you might think a commercial bank is just, a giant vault where you keep your cash safe. But look closely at this definition. They don't just hold your money. They actually have the unique power to create it. And that right there is the absolute game changer. It's the ultimate difference between a commercial bank and other non-banking financial institutions like mutual funds or insurance companies. It all boils down to their lending activities.
They manage the accounts you use every single day, they advance loans for your house or your business, and they facilitate payments every time you swipe your card. They also handle agency and general utility services. But here's the thing. While accepting deposits and issuing loans are totally standard operations, it's exactly how they connect your deposits to someone else's loan that sets up our next massive concept.
Section 2. The magic of credit creation.
Okay, imagine I walk into a bank and deposit 1,000 rupees in cash. How on earth does that single primary deposit of 1,000 rupees transform into 5,000 circulating in the wider economy? It sounds like magic, right? Well, let's anchor our attention on the step-by-step math we're about to sketch out to solve this exact puzzle.
Now, what's really interesting about this slide is how the numbers cascade down these columns. Say our depositor puts 1,000 rupees into the Bank of Baroda. By statutory law, the bank must keep a minimum cash reserve ratio. Let's say it's 20%. So they lock up 200 as reserves, and they loan out the remaining 800 by creating a new derivative deposit for a borrower. Now that borrower goes and uses that 800 to buy goods, and the seller takes that same 800 and deposits it into their bank, say Canara Bank. Canara Bank then keeps 20% of that, which is 160, and loans out the remaining 640. That borrower spends it, the next person deposits it into ICICI Bank, who keeps 20% and loans out 512. Do you see what's happening? This cycle of depositing, reserving, and lending just continues on until that original 1,000 in cash has generated 4,000 in new loans, creating a total of 5,000 rupees in the system.
And this brilliantly illustrates exactly where that number 5 comes from. In economics, this is known as the deposit multiplier, and the formula is beautifully simple. It's literally just 1 divided by the required reserve ratio. Since our required reserve was 20%, or 0.2, 1 divided by 0.2 gives us a multiplier of exactly 5. This tells us the maximum multiplier effect an initial cash deposit is going to have on the entire banking system.
Of course, this magic isn't actually infinite. It relies on a few really important real-world boundaries. First off, the multiplier is limited by the total cash the public actually decides to deposit. It's also heavily controlled by that cash reserve ratio set by regulators. Plus, it relies heavily on the banking habits of everyday people. Think about it. If everyone suddenly panicked, stuffed all their paper cash under their mattresses, and just stopped using banks entirely, this magic cycle instantly breaks. And finally, prevailing business conditions matter a lot. Banks literally can't create credit if businesses are in a recession and don't have the confidence to take out loans in the first place.
Section 3. The macro view. The central bank.
So, what happens if those commercial banks get a little overzealous? Let's say times are a little too prosperous, and they create way too much credit, flooding the economy and causing massive inflation. Well, enter the central bank. Think of the Reserve Bank of India or the Federal Reserve. This is the absolute apex institution in our financial sketch. Unlike the commercial banks we just mapped out, the central bank has absolutely zero profit motive. It doesn't deal with the general public at all. Its sole purpose is to formulate monetary and credit policy to manage the economy, making sure we maintain stability and growth. And their responsibilities are absolutely massive. Let's rapidly break them down. First, they hold a strict monopoly on issuing paper currency. They're the only ones running the printers. Second, they act as the banker, fiscal agent, and financial advisor to the government itself. Crucially, they are the banker to the commercial banks, securely holding the centralized cash reserves for the entire system. And if a commercial bank runs into a severe cash shortage and exhausts all its funds, the central bank steps in as the lender of last resort to prevent total financial panic. Plus, on top of all that, they act as a custodian of the entire nation's foreign exchange reserves.
Section 4. Levers of credit control. All right, first up in their toolkit is the repo rate. Simply put, this is the interest rate the central bank charges commercial banks for short-term loans. If the central bank wants to cool down inflation, they just raise this rate. It makes borrowing more expensive for the banks, who then immediately pass that higher cost straight on to you, meaning your car loans and mortgages get pricier and overall credit shrinks. Conversely, we have the reverse repo rate. This is the interest rate the central bank pays to borrow money from the commercial banks. By raising the reverse repo rate, the central bank effectively encourages commercial banks to park their excess short-term funds safely with them to earn higher interest, rather than, lending it out to the public. It acts exactly like a sponge, absorbing excess liquidity straight out of the banking system.
Then there is the cash reserve ratio, or CRR. Remember our earlier math example where the banks had to keep 20% of their deposits locked in the vault? Well, that exact percentage is set right here by the central bank. If they decide to increase the statutory minimum percentage, the commercial bank's capacity to create credit shrinks dramatically, simply because they have less excess cash available to lend out.
So the crucial point here is that all of these tools, adjusting repo rates, conducting open market operations to buy and sell securities, and changing the cash reserve and statutory liquidity ratios, are what we call quantitative methods. They indiscriminately affect the overall volume and cost of credit across the entire economy. It's kind of like turning the main water valve for the whole house.
But sometimes you need a scalpel, not a sledgehammer. And that's exactly where qualitative methods come in. Unlike those broad quantitative dials, these are targeted tools used to control the specific flow and direction of credit. For example, the central bank can regulate consumer credit by mandating higher down payments for things like cars. They can adjust margin requirements for borrowing against securities just to curb stock market speculation. They can even use moral suasion, which is basically requesting and strongly persuading commercial banks not to lend to unproductive or highly speculative sectors.
Which brings us to the final page of our notebook sketch for this explainer. We've seen that the limits of credit creation rely heavily on the banking habits of the public, specifically how much physical cash people keep under their mattresses versus inside the banking system. So I want to leave you with this provocative thought. As developed economies shift rapidly away from paper currency and rely almost entirely on digital payments and transfers, how will these changing banking habits alter the traditional limits of credit creation? Are we entering an era where the deposit multiplier behaves entirely differently? It's definitely something to ponder the next time you watch the numbers move in your own bank account. Thanks for sketching this out with me today. Keep exploring and keep learning.